All right, diving in today, folks, we're looking at, I think, a pretty key development, maybe even a game changer in the Ethereum world. This is EigenLayer.
Yeah, big one for sure. EigenLayer, it's like, this new way to kind of unlock all this potential that's just sitting there. I mean, all that staked ETH, it can actually do a lot more than we thought.
You got it. It's all about supercharging innovation, especially, all these new blockchains are popping up. This could change how they're secured.
For sure. And I mean, for people who are already staking ETH, right, EigenLayer lets them kind of put that ETH to work in a bunch of different ways. Think of it as like a restaking collective.
Okay, restaking, that's the magic word here.
Yeah.
So help me out. What does that actually mean for someone who's already staking their ETH? What are they doing differently?
So basically, when you restake with EigenLayer, you're letting their smart contracts, those things that run on the blockchain, impose some extra rules on your staked ETH. It's like beyond the normal Ethereum staking stuff, right? You're also agreeing to validate these new modules, these new pieces of software.
Modules, okay, got it.
And if you mess up, like you don't follow the rules of those modules, then, well, you could get penalized. That's what we call slashing in the crypto world.
Right, slashing. So basically, by risking more of their ETH, they're actually helping secure these new projects, is that what you're saying?
Exactly. That risk, that's what gives these new modules the confidence, the security to grow, And on the flip side, the stakers, they get rewarded for taking on that extra risk. So it's like a win-win,
Right, so more rewards, more risk. That makes sense. Okay, so to kind of lay out what we're doing today, I want to understand, how EigenLayer makes this all work, this whole aggregating security thing. What kind of opportunities are we talking about? And of course, why should our listeners care about any of this?
Totally. And to really get into it, we've got a whole stack of resources here. We're looking at stuff directly from the Eigen Foundation, their website, the EigenLayer website itself. We've got some juicy bits from their blog to keep us up to date. Oh, and we've even got this academic research paper, very serious stuff. It's called EigenLayer, the Restaking Collective.
Sounds heavy, but hey. That's what we do here, right? Dive deep. Okay, so let's start with this idea of fractured trust networks. Sounds kind of ominous. What's EigenLayer trying to fix here?
Right, so picture the early days, right? Way back, Bitcoin, every new decentralized thing, each new app or whatever, they all had to build their own little security fortress. It was tough, convincing people to join in, to trust this new thing. It was a huge hurdle.
So like a ton of tiny security bubbles, each one trying to make it on their own.
Yeah, exactly. A real pain. And then boom. Ethereum comes along and kind of changes the game. With their EVM, the Ethereum virtual machine, they're basically saying, hey, anyone can build on top of us. You don't need to start from scratch. We got you covered security-wise.
Smart move. Leverage that existing trust. And then, of course, we saw the rise of layer 2 solutions, right? Like roll-ups, all trying to scale things up without compromising security.
Yep. Roll-ups, huge step forward, no doubt. But there are still limits, think about stuff that you can't just plop onto the EVM, right? Like entirely new ways of reaching consensus. Those are like the rules of the blockchain game. Or, what about handling tons of off-chain data? And what about oracles? Those things that bring in real world info onto the blockchain. These all needed their own special security systems, their own actively validated services, AVSs.
Okay, AVSs. Got it. But I guess what you're saying is, even those AVSs, they have their own problems, right? That's where EigenLayer steps in.
Exactly. See, well, with these individual AVSs, you run into 4 big problems. First, you got that same old starting problem. New AVS pops up. It needs to convince people to trust it, to validate it. Hard to get going.
Bootstrapping, right. We've talked about that before.
Yep, bootstrapping. Second problem, see, a lot of these AVSs, they would launch their own token, right?
Yeah.
Their own currency. But that actually means value is kind of leaking out of the Ethereum ecosystem. People are paying fees all over the place to all these different security pools.
Right. Dilutes the whole thing.
For sure. Third problem, it's tough on the validators. The people actually running the computers that secure these blockchains, they got to put up money, capital for each AVS they want to secure, so they're spread thin,
Yeah, I can see how that would limit things.
And the fourth problem, and maybe this is the one that hits closest to home for most listeners, it can actually make the whole system less secure. If your favorite dApp, your decentralized app, if it relies on, say, an oracle that's secured by way less money than Ethereum itself, well, that's a weak link, right? It's like a chain, only as strong as its weakest link.
Gotcha. So all this leads to EigenLayer, right? And their solution, pooled security via restaking. Sounds kind of fancy. How does that work?
Okay, so the big idea is that validators, the people already staking ETH on the main Ethereum network, they can now secure these new modules, these AVSs, without putting up even more ETH. Wow. They basically redirect their ETH. Remember those withdrawal credentials, like where your ETH goes when you finally unstake? They change that to point to EigenLayer's smart contracts.
So it's like instead of going straight back to your wallet, it takes a detour through EigenLayer?
You got it. And then these validators, they can pick and choose which modules they want to secure. Usually means running some extra software, nothing too crazy, but that allows them to participate in how that specific AVS is validated, how it makes sure things are running smoothly.
And those AVSs, they can set their own rules, right? Like what happens if someone messes up those slashing conditions.
Exactly. So what's the big carrot for the validators? Why would they bother with all this? Well, they get extra rewards. It's like on top of the regular ETH staking rewards, they're getting paid by these modules to keep them safe and sound.
It makes sense. More work, more reward.
Right. Now imagine, let's say someone builds a data availability layer, right? Like a place to store tons of data for all these decentralized apps. Validators who help secure that layer, they get paid for storing that data. But, if they fail to prove they actually have the data, slash.
Ouch. High stakes.
Okay.
So EigenLayer isn't just about securing smart contracts, right? It's like any decentralized service could potentially plug into this.
That's the exciting part. Any AVS that can set up its own rules, its own logic for how to validate things, how to punish bad behavior, they can tap into this pool of security from Ethereum. It really opens up the possibilities. Right?
Huge.
Yeah.
Now, I keep seeing this term open marketplace governance. What's that all about?
All right, this is really important. EigenLayer, it doesn't force validators to do anything. It's all about choice, right? They get to decide which modules they want to back based on, the risk, the rewards, their own technical skills, whatever.
So these modules, they make it worth their while, right?
Yeah.
Offer good incentives.
Yep, gotta compete.
Yeah.
It's market, right. And this is good for a couple of reasons. First, it means Ethereum itself, the main chain, can stay focused on its core stuff, like being secure and decentralized. But then on top of that, you have this whole bustling marketplace where all this innovation is happening.
Like a two-layer system, right?
Yeah.
Solid foundation with a lot of experimentation going on above.
Right on. And the second benefit, it actually allows for some really cool specialization. Like some validators might have super powerful computers, or maybe they're comfortable with taking on more risk. So different modules can target different types of validators, which makes the whole thing more efficient.
So basically, EigenLayer is like a platform, like a marketplace, where all these new services can kind of rent security from Ethereum, right?
Exactly. And that solves all those problems we were talking about earlier. Easier to get new projects going, validators aren't spread so thin, and the whole ecosystem, it just becomes more trustworthy.
Love it. Okay, let's talk about how people can actually participate, different ways to get involved in this restaking thing. The outline mentions a bunch of different staking modalities. What's all of that about?
All right, so it's important to know, restaking, it's not exactly like, liquid staking or superfluid staking. Those are different beasts. Liquid staking, that's where you stake your ETH and get a token in return, a liquid staking token or LST. You can then use that token in DeFi, decentralized finance. Superfluid staking, that's like changing the core rules of Ethereum to allow staking of specific tokens.
Okay, different approaches. So where does EigenLayer fit in?
EigenLayer, it creates its own set of options, right? For earning rewards, for securing these AVSs. The most straightforward one, it's called native restaking. That's for validators who are already directly staking ETH on Ethereum, layer 1. They just point their withdrawal credentials to EigenLayer. That's it.
Simple enough, just redirecting their existing state.
Yep. Then you've got LST restaking. So if you're holding those liquid staking tokens like Steth or Reeth, you can deposit those into EigenLayer. So even if you're not running a validator yourself, you can still participate.
Okay, so more options for people who aren't as tech savvy, maybe.
Exactly. And it gets even more interesting. You've got ETH LP restaking, where validators can stake tokens from DeFi pools that hold ETH. And then there's LST LP restaking, which is, a bit more complex, but it basically involves staking tokens that are tied to those liquid staking tokens.
Oh, that's a lot of options. Does EigenLayer, manage all the different risks that come with each of these options?
Actually, no, that's the cool part. EigenLayer, it kind of stays true to that whole marketplace idea, you know? It delegates a lot of that risk management to the people building the modules, the AVS developers. They decide what kind of tokens they want to accept, how they want to weigh the rewards, you know? Maybe they're super focused on decentralization, so they only want natively restaked ETH, for example.
So it's really on the developers to communicate those risks clearly, right?
Exactly. Transparency is key. And for you, the listener, it means you got to do your homework right. Understand the risk before you jump in.
Now, let's say someone's got ETH or those liquid staking tokens, but they don't want to run a node themselves. Is there a way for them to still participate?
For sure. That's where delegation comes in. It's like, you know, you hand your stake over to someone else who's running an EigenLayer node.
Kind of like how you can delegate your stake on the regular Ethereum network.
Exactly. So these EigenLayer operators, they take that delegated stake, they run the software, they validate those modules, and yeah, that delegated stake is still subject to slashing if they screw up. But the good news is they share the rewards with the people who delegated to them.
So operators make money from Ethereum, from the modules, and then they share a cut with their delegators. Everyone's happy.
Right. Now, for those solo stakers out there, I know the folks already running their own setups, they've got options too. They can directly participate in EigenLayer, you know, pick and choose those AVSs, or they can delegate just the EigenLayer stuff, keep their main Ethereum validator running independently. More choices, more flexibility.
Very cool. But one thing I noticed, it doesn't seem like EigenLayer itself is really pushing delegation, right? Like actively encouraging it.
Yeah, it's interesting. EigenLayer, it sets the stage, provides the tools, but it doesn't force anything. You know, in their research paper, they actually suggest that, like, third-party services might pop up to make delegation easier, or maybe even offer some extra incentives for it.
The market will provide.
Yep.
Okay, and last thing on delegation. How are the fees handled? You know, who gets what?
So that's all determined by smart contracts, right? The operator sets up a contract, it's all out in the open, and it says what percentage of the rewards goes to the delegators. It's a pretty transparent system.
Love it. Transparency is key. Okay, let's get serious for a moment. Slashing, right? The big risk. How does EigenLayer actually use that to keep things secure? I mean, we're talking about crypto economic security here.
Okay, so crypto economic security, it's all about making it so expensive to attack the system that no one in their right mind would try it. It's like a deterrent, right? And that cost, we call that the cost of corruption.
So EigenLayer, it's basically saying, mess up and you lose your ETH.
Right, exactly. EigenLayer's smart contracts, they hold those withdrawal credentials, remember? So if someone is caught red-handed doing something shady, well, their ETH can be slashed. And they're out of the game, can't participate anymore. When they try to withdraw their ETH, boom, penalty time.
Okay, high stakes, for sure. Now, I was wondering, EigenLayer doesn't have its own token, right? For restaking, why is that?
Good catch. It's a very deliberate choice. Because, see, each restaker, they're choosing their own adventure, right? They pick the modules they want, and that means they're exposed to different risks, depending on how those modules work. Trying to represent all that with a single token, it would just be way too messy.
So better to keep things simple, transparent.
Right. Now, there's this interesting comparison in the research paper. They talk about merge mining. Have you heard of that?
Vaguely.
Yeah.
Refresh my memory.
Okay, so merge mining, this is with proof-of-work blockchains, you know, like Bitcoin. Miners, they can actually use the same work, the same calculations, to mine on multiple chains at the same time. It's like efficiency, right?
Right, makes sense.
And in a way, restaking is similar. It's like you're reusing your staked capital, but you're spreading it across multiple modules, these different layers on top of Ethereum. So in both cases, you're kind of getting more bang for your buck.
Okay, but I'm guessing there's a catch, right? Security-wise, it's not the same.
Huge difference. See, merge mining, it can actually make things less secure, but restaking, it does the opposite. It makes things more secure.
Explain.
Okay, so with proof of stake, like Ethereum, slashing is the big stick, right? It keeps people honest. Now imagine some validators are also participating in another chain through EigenLayer. If they try to do something shady on that other chain, well, they risk losing their ETH on the main Ethereum chain. It's like the stakes are higher.
Gotcha. So it's that connection back to the main chain that makes the difference. Merge mining doesn't have that.
Exactly. With merge mining, there's no way to really punish miners who act up on those smaller chains. Their main mining operation is still fine.
Okay, that makes sense. Now, I'm sure EigenLayer has its own set of risks, right? What are they thinking about? What are they trying to prevent?
Good question. The biggest one, it's collusion, right? Like, Imagine a bunch of operators, those who run the nodes. They get together and decide to pull a fast one, try to cheat the system. If they coordinate their attacks across multiple AVSs, they might actually be able to steal more than they have staked.
Sounds like a nightmare scenario.
It would be. And the paper, it makes it clear, Ethereum itself, it's not going to bail out EigenLayer if something goes wrong. So how do they prevent this? Well, they're looking at limiting how much profit someone can make from an attack, even if they're successful. And EigenLayer itself, it's constantly trying to raise the cost of attacking, make it so ridiculously expensive that no one would even try.
How do they do that? Make it more expensive to attack?
Transparency is a big part of it. They want to build this open source dashboard, something everyone can see. It would show how much overlap there is between operators in different AVSs. If the same group is validating a bunch of different modules, well, that's a red flag. Right?
Yeah, too much concentration of power.
Right. And then they could incentivize operators to focus on just a few modules, maybe give them bigger rewards for that. They call that elastic security.
Makes sense.
Yeah.
Spread things out a bit. Okay, what other risks are they worried about?
The other big one, it's what they call unintended slashing. Basically, that's when honest validators, people doing everything right, they get slashed because of a bug in the code of an AVS.
That's not good.
Nope. So to prevent that, they're going all in on security audits, making sure that code is solid. And they're also setting up this governance layer, like a group of trusted people who can step in and say, hold on, that slashing wasn't fair.
So like a safety net, I guess.
Yeah, they call it training wheels. It's meant to build confidence, especially for those new AVSs that haven't really been tested in the wild.
Okay, tell me more about this governance layer, this group of trusted people. Who are they, and what do they actually do?
Right, so it's a multi-sig veto committee, basically a group of folks from the Ethereum and EigenLayer communities who everyone respects, They're the guardians of the system.
So it's not like a token-based voting thing, right? It's more about reputation.
Exactly. Trust is key here. So what do? They handle upgrades to the EigenLayer smart contracts, they review those slashing events, and they decide which new AVSs can join the party. They're the gatekeepers.
A lot of power. Could they, go rogue and start slashing people themselves?
Nope, that's the important part. They can only veto slashing, they can't initiate it, and even for upgrades, there's a time delay, Everything's transparent, the community can see what's happening.
Okay. Good to know. So it's like those training wheels eventually come off, right?
Mm-hmm.
When an AVS has proven itself, they don't need the committee anymore.
Right. More trust, less oversight. And to even get admitted, these AVSs, they probably have to go through those security audits we were talking about. Got to earn that trust.
Makes sense. Now let's talk about how these modules themselves, the AVSs, how they're designed. The outline talks about maximizing security while also preventing centralization. How do they do that? All
right. So ideally, the most secure AVS would be one where all the restaked ETH is securing it, right? But in reality, that's not really practical. It would be too expensive, too much overhead. So the paper, it talks about two different design patterns to solve this.
Okay, let's hear it.
First one is the hyperscale AVS. The idea here is to spread the work, the computations, across as many nodes as possible, like horizontal scaling. Right?
So instead of a few big, powerful servers, it's more like a swarm of smaller ones.
Exactly. A great example of this would be a huge data availability layer. You split up the data into tons of little chunks. Each node only has to handle a tiny piece.
Okay, I can see how that would make it harder for one entity to control everything.
Yep. No more central points of failure. The second design pattern is the lightweight AVS. These are for tasks that need to be done by a lot of nodes to be reliable, but the tasks themselves aren't that computationally intensive. Things like, running a light client, verifying those zero-knowledge proofs, or providing price feeds from oracles.
So basically, stuff that even someone running a simple setup at home could handle.
Right. And the key is, by having a mix of these two types of AVSs, the hyperscale and the lightweight, it means more people can participate. Even those home stakers can earn some rewards. That helps keep the whole system decentralized.
Love it. So EigenLayer, it's not just about theoretical stuff, right? They've got real world examples of what could be built on top of this.
Oh yeah, tons of possibilities. We already talked about that hyperscale data availability layer. That could be huge for rollups, make them way more efficient. And then there's decentralized sequencers for rollups. That could be a game changer for security and censorship resistance.
Yeah, decentralized sequencers, that's a hot topic right now.
Totally. And then there are bridges, connecting different blockchains. Those could be made faster and more secure with EigenLayer. And of course, oracles, those things that bring in real-world data, they could be built on EigenLayer too, leveraging all that staked ETH for reliability.
Okay, so data, bridges, oracles, what else?
Well, we could see things like, systems that trigger actions based on events happening in the real world. MEV management, that's like, extracting value from the order of transactions. That could become more decentralized and fair. Even the idea of like super fast settlement chains, or even maybe, this is getting really out there, but even making Ethereum itself finalize transactions in a single slot.
Wow, a lot to unpack there. So much potential. The research paper also talks about something called staker heterogeneity. What's that all about?
Right. So basically, it's recognizing that not all stakers are created equal, right? Some have way more computing power than others, some are more risk averse, and so on.
And normally, blockchains try to cater to the lowest common denominator, right? To make sure everyone can participate.
That's the usual approach, yeah. But EigenLayer, it's like, hey, let's leverage those differences. Let's make use of all that variety.
How so?
So you could have certain validation tasks that require more powerful hardware, right? And those with the resources can step up, earn bigger rewards, but of course, maybe take on a bit more risk. It's about using everyone's strengths.
And it's not just about computing power, is it?
Nope, it's about like risk tolerance. Some people are comfortable with more risk than others. And then there's even this idea of on-chain identity, like, verifiable credentials or those soul-bound tokens. Imagine modules that specifically target stakers with certain credentials or attributes.
Interesting. So EigenLayer, it could actually make Ethereum more decentralized, right?
Yeah.
By empowering those home stakers, making it more worthwhile for them to participate.
Exactly. See, in a lot of systems, there's this natural tendency towards centralization, but EigenLayer, it has mechanisms to fight that. Like AVSs, they can actually require that validation be done by a decentralized group, even specify that only home stakers can participate.
So they're basically like buying decentralization by making it more profitable for the little guy.
You got it. It creates this positive feedback loop, right? More decentralization on EigenLayer means more decentralization on Ethereum itself.
Now, this whole multi-token quorum thing, that also seems pretty innovative. Why would an AVS want to use its own token alongside ETH for consensus?
Okay, so this is all about giving those AVS more flexibility. They can bootstrap their own token or, create their own little economy. But at the same time, they still have the security of ETH backing them up.
2 layers of security, 2 different tokens.
Exactly. It's like a safety net, right? Even if their own token struggles, the ETH is still there to keep things running smoothly.
Smart. So all this leads to the question, right? How do these AVS actually make money? What kind of business models are we talking about?
Well, the paper outlines a few different approaches. You've got your classic fee-for-service model. Yeah, users pay a fee to use the AVS, and that fee gets split between the operators, the ETH stakers, maybe the EigenLayer protocol itself.
Right, pretty standard stuff.
Then there's the idea of like giving out tokens to those who provide the service, both the operators and the ETH stakers. And of course, some AVSs might just charge fees in their own token, hoping that the token will become more valuable as the AVS itself grows.
So a lot of different options depending on how the AVS wants it to structure itself. Now, the Eigen Foundation, they're kind of the driving force behind all this, right?
Yeah, they're the ones pushing this whole vision of like humanity's coordination engine for open innovation.
Yeah.
Very ambitious stuff, right? But it really fits with what EigenLayer is trying to do, making it easier to build new and exciting things on top of Ethereum.
And they're seeing some real traction too, right? All those metrics, billions of dollars locked up, tons of new modules being developed.
Oh, yeah. EigenLayer, it's definitely making waves. It's still early days, but the momentum is definitely there. People are excited about the possibilities.
Well, I think we've covered a lot of ground here today. To sum it all up, EigenLayer, it's creating this whole new marketplace for decentralized trust, right? Giving Ethereum stakers more ways to earn rewards, and ultimately it's making the whole ecosystem more secure and innovative.
Exactly. It's like taking all that power from Ethereum, all that staked ETH, and using it to supercharge the whole decentralized world.
Awesome. So for our listeners out there, here's something to think about. This whole idea of renting security and these multi-token quorums, how is this going to change how we build applications in the future? What crazy new stuff will we see? It's a really exciting time to be following this space, and we'll be here to break it all down for you right here on The Deep Dive. Thanks for listening.